Hey traders, this is Blake Morrow with Traders Summit, and I'm happy to report it's Friday. We're at all-time highs, and I have Mr. Jim Welsh from Macro Tides joining us, and that's what makes Fridays great. Good to see
Oh,
you,
you're
Jim.
such a smooth talker. Thank you.
Well,
And
hey,
this
look.
and you make Friday special for me.
Well, yeah, because it's about time to ring the bell, right? So it's like
Ding dong.
ding dong, get me the hell out of here. Hey, look, it's another week at all-time highs.
Yep.
What's changed, Jim? Because stocks, I mean, we're at 5,100 on the S&P, and it doesn't look like there's
Yep.
any stopping in sight right now.
Yep. Well, obviously, NVIDIA carried the day and the week so far. And it's a great company. They make great products. They're in great demand. So I get it. To me, the feverishness surrounding that stock and semiconductors in general, it's more the amplitude of the emotion as opposed to how legitimate NVIDIA is. It's very legitimate. So there's no question, compared to the old dot-com stocks, there were a lot of them that were just fluff and so forth. What's changed is, and a couple, 2, 3 weeks ago, we talked, and I said there's the potential the S&P can get up to like 5219. Now, my perspective has been is that I have thought that the S&P would pull back to 4850, 4800 before we got that move up. And, I was wrong in the sense of NVIDIA, blew out the lights, and we may be moving to that target sooner rather than later. Does it change the bigger picture? For me, no. And there's some things we're going to review that, provide some of my reasoning. But, again, we're obviously in a speculative environment.
Yeah. Well,
So,
if you're an asset manager, you're an institution, you're just forced to chase this market. I mean, there is no alternative. What, I'm going to go
mhm.
park my stuff in bonds right now and get this mediocre, 3, 4,
Yield.
5%, whatever
I
yield
gotta
I'm
wait a whole year for.
annually, where I can literally capture that in 2 days if I catch this right.
Hours.
Hours. Okay, hours. But
Where we're at.
that's what the market's facing right now. So that we're at a point where
Yeah.
valuations just don't matter, right?
Right. Right. And that is kind of a mania type of environment and mentality begins to creep in. And in a sense, the focus that people have narrows from a broader perspective to whatever it is that's moving. And so, option volume, has been, pretty consistently around 50 million options traded every single day. Half of that volume are options that have an expiration of 6.5 hours. In other words, they expire today. So my point here is the increase in volume on that kind of vehicle is reflective of a speculative environment. That doesn't mean it can't last for another week, another month. That's the reality. Something has to, in a sense, it's the old movies of, somebody would be groggy and they'd throw a glass of water on their face and the guy would like amazingly wake up or something, right? But that's kind of what has to happen is there has to be some kind of glass of water that breaks the spell. And, last week on Friday, the super micro chip company, it
SMCI.
traded from 1,080, I think it was, to 792 in a little over a day. It was up, I think, 14%, 30% yesterday. Is down a lot today. So again, all these are symptoms of somewhat of a manic speculative psychology, and it has to be respected. And so I thought 5219 was a possibility. I just thought we were going to have a dip first and then potentially that move up. So I think what's obviously happened as of yesterday is, we're making progress toward that 5219 target.
Yeah.
What was left unsaid, and we're going to cover some stuff, is I think that we're approaching what could be a very, very significant high at whatever level, price level we ultimately reach.
Okay. And so that, I mean, that's interesting when you have like wave counts. It's like, okay, we're in this fifth wave or a third wave or whatever you're going to show
Right.
us.
Right.
But those waves, that wave could be further than where we're at right now. It doesn't mean like today is not
Yeah.
sell Mortimer sell day necessarily.
I wouldn't yet,
Yeah.
but no, again, I mean, for me, when we talk about waves, obviously we're inferring Elliot Wave.
Yes.
All right. I've been using Elliot Wave for a long time. I think I'm reasonably, efficient at it. I will say 1/3 of the time, Elliott Wave, it can be really pretty helpful. And we've talked about, like TLT making a low 5 waves down last October, very helpful. 1/3 of the time you have 2, maybe 3 options. And then 1/3 of the time it's useless. And so that's how I use Elliott Wave, is with that perspective. And that's why one always has to use a lot of other technical indicators that help predict stuff. So, the pattern allowed for a move to 5,200. The pattern as it stood up until the last hour of trading on Wednesday, said, okay, pull back to 48.50, not unreasonable.
Yeah.
So again, this is all probability business. And it's just important to keep that in mind.
Yeah, it sure is. All right. Well, Jim, let's get into the charts that you brought, because I'm going to just tell you right off the bat, they don't matter. Whatever you tell me right now,
Of course they don't.
La 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 la. I don't care because it doesn't matter. But jokes aside,
Yep.
this stuff does matter. Let's start off with your first one, which is going to be rates. Let me make sure I got that.
Correlation of rates and stuff. So again, ironically, the Fed minutes from the January 31st meeting came out a couple hours before NVIDIA's earnings, and no one paid any attention to them. All right, and I think those minutes showed clearly that a rate cut isn't coming anytime soon. So what this chart shows, it's a little busy, but the dark blue line are the changes in the federal funds rate as priced in. So what we can see in early January, Wall Street was looking for 7 rate cuts. We're coming up to about only expecting 3 rate cuts, which is exactly what the Fed has indicated. The yellow line is the 10-year Treasury yield. And then the light blue line is the S&P. The S&P has been inverted so that you can align it with the yield. If you go to the left side of the chart, you can kind of see how all 3 lines pretty much moved together. We got to that high in Treasury yields in October, and then Wall Street started pricing in more and more rate cuts. The 10-year Treasury yield came down. The S&P rallied very nicely. What we've seen in the last month or so, 4 to 6 weeks, is a divergence. The yields are going up, but the S&P is completely ignoring that trend. I
just want to stop you here really quick and interject. Please. That's been the real big disconnect this year, is because we all looked at the rate cut expectations and we're like, that's just absolutely nonsense.
Ridiculous.
It's ridiculous. And we talked a lot about that over the last 6 weeks or so. The Fed's not going to be able to cut rates six times. You're crazy. And you've been very consistent in saying that. Yeah. But the disconnect is the market doesn't care.
Yeah. Well, and here's the reason. And we also talked about this. At the end of last year, beginning of this year, the market narrative was based on 2 legs. One leg was the Fed's going to cut the funds rate 6 or 7 times. The other leg was the economy's not having a recession. It's going to just keep on growing. And so, what's turned out is that the rate cuts were kind of like a bonus. And on top of it, the Fed's going to be cutting rates. So to me, what's happened here, Blake, and we've talked about this the last, I think, few weeks, how Wall Street has, if you will, defaulted to, the rate cuts, sooner or later we'll get some rate cuts, but the more important thing is that the economy is on solid footing. I
Yeah.
mean, in the last week, I've heard people talk about and refer, like Jim Cramer, and I'm not singling him out per se, but he referred to the economy as roaring. Okay. And so there's that sentiment out there that, hey, the economy is doing really good. So the fact that we're not getting rate cuts only validates the idea that the economy's in great shape. And I think that's what's been driving the market. And ultimately, the fact that the Fed isn't going to be cutting rates anytime soon is important. And I think the next chart will kind of like, will build on that. So real funds rate is effectively the federal funds rate minus inflation expectations. This is what this chart happens to be based on. You could do it on the core CPI or core PCE and so forth. But my point is the dark blue line is the real funds rate. And we can see that it's up around 2.5%. If you look to the left, you see in 2007, it's just about where it was in 2007. 1999, it was up around 3.8. So not quite to where it was. My point is that the real funds rate is at a restrictive level. And we've talked about this. There's two types of financial conditions. There are market-based financial conditions based on the S&P 500, Treasury yields, the dollar, yield spreads, and then Main Street financial conditions. Main Street financial conditions are based on the real funds rate. So that if you're a small business, you've seen absolutely no relief on your loans. If you're a consumer and you've got personal loans, auto loan, or you're thinking about buying a car, credit cards, and all that. So the point being is the longer the Fed delays in lowering the funds rate, all the borrowing in this country that's tied to the prime rate, which is tied to the funds rate, continues to be high. And so the probability that the economy is going to slow more obviously should, to me, it's logical, increase the longer the Fed keeps the funds rate at this restrictive level. That message, as you noted, nobody wanted to hear. But that is the reality. And my take continues to be that the ultimate outcome of the largest increase in the funds rate in 40 years, the biggest increase in lending standards in the last 40 years, has just been delayed by excess savings and federal spending. I mean, the government ran a deficit of 6% last year. That 6% is going into the economy, one form or another. So those are the reasons why I think the slowdown has been delayed. I am in the camp that believes that as we get toward mid-year, we're going to see more of that slowdown materialize. And if that happens, Blake, that second leg, that Wall Street's depending on in terms of, hey, no, we have to worry about a recession. I think there's coming a time when they will be like, whoa, things are starting to slow a little bit more than we expected. If I'm wrong, we'll just keep kind of doing what we've been doing.
And that, I mean, it fits into your next chart, which we're in the, you know it, right?
Yeah. Yeah. We talked about this, I think either late December or first week in January. And this is the 17-year cycle. We'll go through it very quickly. Somebody can, pause the button, if you will. But going back to 1939, the S&P has hit a meaningful high every 17 years. The reasons have varied. And so to me, 2024
be the year of the
dumbassness,
right? Just kidding.
Well, no, I mean, again, for some people, this is just voodoo. You
right,
can't,
of course.
It's like, okay, fine. I have no idea. I'm not trying to explain this. Like, okay, this has been a pattern. Human activity fluctuates in patterns. It just does.
And there's a reason why when they say, when you talk about like generational highs, generational lows, usually that's around 20 years.
Yeah. That's an interesting point.
Around 17 years, maybe in this case. But
But
go ahead,
why
Jim.
not?
Continue explaining.
So anyway, that to me is like, all right, I'm nuts. I kind of think that I want to pay attention to this, that somewhere in 2024, there's a fairly a high probability there will be a meaningful decline. So is it going to be the 57% or 48% that happened after 73 and 2007? Let's say, nope, not. But if it's 14%, that's pretty meaningful, So, and then the next chart, kind of is a 2-year cycle. And what's interesting is, for whatever reason, is January of 2018, then February of 2020, then January of 2022, and here we are in February 2024. And this 2-year cycle is due about this time when we're seeing all this enthusiasm and speculation. And again, this to me suggests that based on this cycle, we're entering a window of vulnerability. It doesn't mean the market can't rally to 5,200. It just, for me, suggests when I look at sentiment and some of the technical underpinnings of the market that no one's paying attention to any of this stuff.
Jim, I'm going to come back to your charts because we're going to go into the technical view of like the S&P and whatnot. But I want to have this conversation with you because this is where, I've had some personal conversations, one-on-one conversations with our community about this. But before I go into it, I just want to say, if you guys and gals listening enjoy Jim, make sure you give him a thumbs up, subscribe to this channel down below so you don't miss any of this very exclusive content only here on Traders Summit. Jim, so, when you're sitting here at, let's just call it 5,100 in the S&P, and I think we could all agree that being in these markets and seeing Blowoff Top Mania type of markets in the past, and the one that comes most to mind for me is the dot-com bubble in 99, 2000. I don't know at this stage, at this moment, if we're in 1999 or in 2000. I don't know if we're in mid 2000 or late 2000, if we're in 2000. But if you feel that the markets could have a significant decline from current levels, I would agree with you. If you said, hey, Blake, do you think we could have a significant decline from where we currently sit at 5,100? Do you think we can have a significant decline? My answer would be yes. But I could also argue, why couldn't we see 6,000 in the S&P before 3,000? Or 6,000 before 4,000, right?
Yeah. No, in a mania, that is the environment that you get to. In order to derail any train, there has to be a reason to sell. And right now, the point you're making is that market doesn't care about anything other than, what's happening with the chip stocks, NVIDIA, markets going up. It doesn't care about anything. Oh, we're not going to get a rate cut. Well, we can survive. The economy is going to be okay.
Right.
So is it possible? Absolutely.
Yeah. And it's also possible that today is the high that we're talking right now.
It's possible. I mean, some of the semis have reversed a little bit and all that. We're in an environment where I just think risk levels are high, ultimately, in terms of where are we going to be 3 to 6 months from now. But you're right. And when you get, I remember in 1999, late 1999, things were nuts. And then the NASDAQ, I think, ran 20% into March of 2000. So, when the concentration is narrowly focused, and yet those stocks that are legitimate companies are 30% or so of the S&P 500, can they go up another 10%? They can. If they do, that's going to add another 3% to the S&P all by that self, which is what? Another 150 points. So until the spell breaks, until a reason to sell shows up, beyond just normal profit taking, the ebb and flow and all that happy stuff, we're not going to see a meaningful decline. Again, I think the reasons are going to be showing up, but they're not here right now, obviously.
All right. Well, let's take a look at your charts that you brought and see if we can come to any technical conclusions. So here's the S&P chart, Jim. What are we looking at right now?
Well, basically, the top panel is the S&P. The bottom panel is this 21-day advances minus decline oscillator percent. It's an indicator that I develop and use. And what one wants to see is the S&P gaining altitude and that indicator continuing to work its way higher. When it starts to diverge, if you go back and look at last July, the S&P rallied for about 2 weeks after this thing topped, but it ultimately led to a pullback and turned out to be a fairly deep pullback. In October, you can see that in late September, it reached a low, the S&P bounced, and then it went down to a lower low, but this oscillator hit a higher low. It was one of the reasons why I was looking for a rally. Now we're seeing this divergence that's extending, where despite the kind of strength we're seeing, the breadth yesterday was positive by about 650 issues. For the S&P being up 105 points, a more realistic would have been like, how about 2,000 issues?
Yeah.
So again, the concentration is very significant. The weighting of that concentration in the S&P is significant, and that can continue to run, but underneath the surface, there isn't as much strength. So people keep talking about the Russell 2000. It continues to underperform. Again, until the spell breaks, one has to, I respect that the market can make a move. Now, that 5,200 target was effectively the low in 2022. In October was 34.92. The high in last July was 46.07, about 1,115 points added to the 41.04. Gets you to 52.19. So effectively just saying you had a rally off the low, you had a pullback. If the two rally phases are equal, that's how you get up to the 52.19.
Okay. All right. Very good. All right. Let's continue on with your other charts. This is your 10-year. I've been pretty bullish yields. Looks like you might be too here based on what we're seeing. What are you forecasting here?
Yeah. Well, again, going back to the 5 wave stuff, you could see 5 waves down from the high in yields last October to the low in December.
Yeah.
To me, that was a signal that we were about to see Treasury yields go up and retrace some of the decline that they've had. And, that's what's been transpiring. I think there's a little bit more room to run for yields to tick higher. I can't say. I think the wave C could get to, is it 446 or something? I can't see that. Our mugs are covering that right now.
Oh.
But yeah. So I think potentially there's a little bit more, but they've satisfied the minimum expectation in terms of the amount of retracement and the 2 equal legs and all that happy stuff. So I think we're nearing a high in Treasury yields. But I'm in the camp like you that I think there could be another little shot to the upside before that correction is complete. The 5 waves down from October to December. My conclusion is that is the first part of a larger rally. That we were going to see a retracement, which we had, and then there's going to be another rally that takes Treasury yields below the lows that we saw in December. The 10-year getting down to maybe 325 to 335. And the only reason that can happen, Blake, in my view, is the economy starts to slow more than expected. And lo and behold, the Fed does start to lower rates more aggressively, not because inflation is down, but because the economy is weakening. Yeah. So the bigger picture to me suggests the bond market is kind of saying, here's what it's suggesting is there's another large decline in Treasury yields coming. And you have to say, well, what could cause that? It isn't lower inflation. That's behind us. It has to be weaker economy. So,
and just so everybody can see, like, I'm kind of looking at the same thing because we have this double bottom. Here's your neckline, and then the double top will actually take us right around there. So that's kind of
Yeah.
what I was thinking too. A couple different ways to look at it, and I think as yields continue higher, I mean that should theoretically continue to benefit the dollar. But here's your next
Yes.
chart. So here's the dollar.
Well, what we talked last week is, hey, the dollar has also kind of finished the minimum expectation of getting to where it got to just below, I think, what is that, 105, I think was the
Yeah,
high.
and you've been just, in your defense, just to compliment you, you've been looking for 105 since last year, like
A
end of
while. Yeah.
last
I
year.
mean,
So,
it was like, okay, for sure, I think we're going to 104. And then, anyway, but again, you should see the 5 waves down in the dollar. Well, that implied that we were about to get a rally. And if the dollar was going to be rallying, well, why would that happen? Well, I think Treasury yields could go up. And the idea that the Fed was going to cut rates 6 or 7 times was wrong.
yeah.
And as that dissipated, we would see strength in the dollar. So to me, the confirming thing would be a close below 103.80. We dipped below it intraday yesterday, and we're close to it today.
Right. And so and here's where, and just, I obviously have a lot of views on the dollar because I trade currencies predominantly.
Yeah.
I know you believe that the dollar could theoretically, on a breakdown could really, really head lower. I'm not in that camp, not yet, but
Yep.
I'm waiting for you to prove me wrong, Jim, in this one. So
Well, we're going to need
we'll
the
see about
economy
that
to
as we get.
slow.
What's that?
Like the economy has to slow.
Yeah.
Okay.
Yeah.
Again, this is how this stuff, and from my perspective, comes together.
Right.
Is, well, what would cause Treasury yields to come down a lot? What could cause the dollar to come down a lot? Well, the economy actually does start to slow more than expected. And lo and behold, the Fed's cutting rates, not because inflation is down, but because the economy is starting to slow.
Makes sense.
And I think that would undermine the dollar.
Okay. So your last chart you brought us is gold, and I know people are anxious to see what you feel here because it has been a nasty, choppy, no fun.
Yeah.
Like I have no direction type of.
Yeah, shrink it just a little bit, would you? The chart, Blake, please, because okay. So I thought a couple 2-3 weeks ago that gold was setting up to dump. I think that was the word I used. It dumped, but it didn't take out 1974. So, in other words, there's no follow through, which is like, wow, this should have followed through, but it didn't. Now we're at a point where the dollar chart is looking increasingly like it's about to roll over. And the gold took out that trend line, and now we're hugging the underside of it. And I think there's the potential that gold's going to pop above that trend line, and then we'll see what kind of a rally can it muster. Can it get above, that 2061, 64, make a run at 2088? Or possibly is it going to go above 2122? I don't know. I'm just looking at this chart and it's like, it just looks like it could pop. And with the dollar looking like it's rolling over, to me, that looks potentially upside. So you're right. Triangles or choppy. I mean, this thing's been chopping for months in a narrowing range. My guess is something's going to give. And I'm leaning more now that it could rally again based on the dollar.
Yeah. Okay. Well, I guess there's a lot that could happen, especially in the coming weeks. But I tell you, Jim, it's nothing but great to have you here to help guide us through the markets. I appreciate you being here with us every Friday. If you guys feel the same way, make sure you give Jim a big thumbs up. Jim, what's the best way for us to follow your work? If you're like, I can't get enough Jim, just Friday is not going to be good enough. Where's the best way to get your work?
Macrotides.com. Send me an email, Jim Welsh Macro at Gmail, and I'll send you a recent publication. The PCE for January comes out next week, Blake, before you and I speak.
Mm-hmm.
And I think, again, we've seen the CPI, the PPI. There's components in the PPI that bleed through into the PCE. So that just, to me, suggests maybe the PCE shows some level of stickiness, which, again, has the potential, maybe yields pop a little bit on that and so forth. So that I think that might be the most important number, because I can't remember if the payroll number is going to come out next Friday or the
I
following
don't think
Friday.
it is. I think it's going to be the following Friday.
A lot of times if the Friday's the first day of the month, they wait another week.
Which it happens to be. So with that being said, Jim, I look forward to seeing you on March 1st. And for everybody else, I want to thank you for being with us. Jim, appreciate you, and good luck navigating through these markets.
You too, Blake. Everyone stay well.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.